What is volume in stock market? What I'm going to share with you today, we're going to be using TradingView here for the volume indicator. And I want you to understand volume in trading. And this is so powerful. And I'm going to explain with you with an example of a couple of different ways to treat this. And volume is one of those things that really should be at the heart of your trading. And because here's how to think of it. When we talk about volume, a lot of people, they don't really totally get the idea. So here's our volume plotted down here on TradingView. And what does this represent? Not even what does it represent. What is it graphically plotting? Literally graphically plotting. It is plotting money. So I encourage you to help you in your trading to substitute the word volume for money. Dollars, dinero, won, yen, euro, whatever it is, it's money moving through the market. So when you call it money instead of volume, not that volume is wrong, but it helps you to keep in the front of your mind, your conscious mind, wait a minute, what's happening here? And what's happening is, let's clean this up a little bit, is money makes the markets move, okay? Money makes the markets go round. So I do not believe money makes the world go round. Love makes the world go round. But markets make money makes the markets go round. So let's make that distinction just for sake of, well, keep our priorities right. So more demand than supply, prices go up. More supply than demand, prices go down. That's about the money coming in. Now, let me ask you this question to lead up to this. Use the Socratic method a little bit. So this shows you how much money is coming in. And sure, if it's different markets, it's shares, lots, contracts. But when we see a lot of money coming in, that is a very, very important sign for a couple of reasons. Number one, yes, there's a lot of strength, financial power behind that. Okay, so yes, that is one. Demand, absolutely. But there's a second level of understanding to this, and that is this. Tell me, in fact, type into the comments below if you want to really test yourself here, who has bigger trading accounts? Your average amateur trading from home? Average mom and pa trading on their laptop, desktop, cell phone, whatever, or the institutions, professional traders. I'm talking about hedge funds, banks, sovereign funds. Now they're trading with hundreds of millions, more like billions, in some cases even trillions of dollars, whereas the average retailer is trading with hundreds, thousands, maybe 10,000 or maybe 100,000. But even that's rare. But even if they're trading with $100,000, that's nothing compared to billions, right? The ratio there is just so whacked. So the extra bonus that we get for following big volumes of market is that we're not only following the demand, yes, we're doing that, but we're also following the smart money. And as opposed to following the amateur trader, the small volume, which is the, oh boy, better be careful here, is the unsmart money. Or not as smart money. That sounds even nicer. And knowing that 95% or so of traders lose money, I'd rather go with the smart money. I think you would probably too. So that is why, those are the two reasons why volume is so critical in your trading. By the way, real quick, if you have a favorite volume indicator, type it into the comments below. I'd love to see and compare and get feedback from people what your favorite volume indicator is, what you're using now, and if it's working well for you. So what I'm plotting here, by the way, is not a volume indicator. This is raw data. That's another thing I want to make clear, because I've gotten this feedback from students and people that I've taught in my seminars. They think this is an indicator, and it's not. It's deceiving because a lot of trading platforms, they will put this tool, we'll call that a tool, they'll put this tool in the list of indicators, and therefore it seems like, oh, it's an indicator because it's in the list of indicators. But technically it's not. An indicator is a mathematical formula, and this is not a mathematical formula. These bars are literally telling you the data. They're data. There's no math equation involved. Just like with price, no calculations done there other than, oh, here's where the market opened. It went down to there, went up there, and it closed there. They're just data points. It's not run through any kind of calculation or algo. And the same with volume. That's how many shares, contracts, lots, dollars were traded. And that's why it's important. So these are not, neither one of these are indicators, price or volume. Okay, but there are volume indicators if you choose to use those. All right, so having said that, I just had to really say that because this is how I trade it. So when we get a breakout, okay, we've had lows, 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 and then boom. By the way, quick, because I'm going to bring this back up later. 1, 2, 3, we touch this, create this resistance with 3 levels, and then boom, we zap up above that. We zap up. That's the new term. Instead of gap up, now Gen Elemental P is calling this a zap up. But look, the real important thing here, all jokes aside, is how much volume comes in. Lots of buying. So this is not created by, Billy Bob in, I shouldn't mention any locations, but, it's just not created by someone who has little money. It's created by the professionals, people with big money. So lots of money comes in, and now we can say, oh, okay, that is the beginning of a new trend out of consolidation. There's a lot of power behind this, just financially, and there's a lot of smart cookies behind this. All right, so that's what we want to see at the beginning of a new move. So now that we've talked about the beginning of a new move, let's talk about the end of an old move. So this is how we get into a trend. How do we get out of these trends? To get out of trends is a different situation. Now, especially, and they can vary. You can get V-tops and V-bottoms with the single volume bar like I showed. But especially when it comes down to bottoms. Bottoms generally tend to trade differently than tops. And this is the way that I look for it. Again, always know there's exceptions, but these are the patterns I like to trade. So market's been coming down. All right, we've been down. All right, awesome. So we've got that. Now, what do we got down here at the bottom? Notice that we get increased volume, but the market doesn't go up right away. So as opposed to before, where, okay, we got a pretty large green bar there, pretty big bars there. Again, pretty big bars there, quite a big bar there. But the gall dang market doesn't go up anywhere. It comes down, it makes a lower high, makes a lower low, comes back up, but all this volume is coming in as opposed to if you look over here. All right, again, at the beginning of the down, we did have good volume. So, but now this is, where's our trend change? That's the question. Where's the trend change? Where's the, now, so here's the difference between tops and bottoms. So let's move over here a little bit. And this is what I like. So when price comes down and we get big volume, what the professional traders like to do at bottoms is accumulate. And so accumulation, it's called accumulation distribution. You might have heard of it before. I'm sure some of you have, in fact. And so there's not any one volume bar that was ginormous like we saw before, but we definitely have more than average volume coming in here, more than average volume coming in here, more than average volume coming in here. So what they're doing is they're accumulating over a period of time. Here it's over more than a month, actually. And why do they do this? They do this because if they brought all their money in, all their billions of dollars right at one time, again, that demand would spike the price up, and they don't want that. And the reason they don't want that is because they got so gall darn much money to come in. What a problem to have, right? So they have so much money to come in that they need to bring it in over a period of time, because if they just brought it in at all one time, the market would spike and they would get filled at higher and higher and higher and higher prices as that initial volume spiked the market. So they say, no, we don't want to give our position away too much. And so they will accumulate through this period of time, more than a couple of months. And we call this, by the way, this is part of the Top Dog Trading rule of 3. So that's what I look for. 1, 2, 3. So 3, good, again, decent, more than average volume, but not crazy spiked volume. And now this is where a lot of people get confused. And I know because I've taught this and people have asked me, and they say, okay, and then we go up from here. And then our new trend starts. We get our trend reversal. But the feedback that I've received is, but Barry, hey, there's not a ton of volume here. We're back down to, average volume in this whole zone here. I would say right, because they already took their positions here and here and here. And that's exactly what they want. And they don't want to show their hands when actually the market's they want people to be discouraged down here. That, oh, you can try to go up, didn't work. Try to go up, didn't work. Try to go up, nope, didn't work. And they're bringing in, accumulating positions, and then they don't want to show their hand here, and away to the races that it goes. Now, what's very important here to finish up is I mentioned that we had 3 lows. Okay. The problem is, how do you identify those 3 lows? Because it can be very subjective. So I don't trade subjective. Everything I do is mathematically based, statistically based, rule based on literal math. Math's pretty good. Math's pretty good. I found that, it's accurate roughly 100% of the time. So what I did was I created a market entry indicator that is a mathematical formula. Happy to share it with you. And in fact, all my viewers get it for free. Just go to indicatorwebinar.com, and it's my market entry indicator I use for every single entry I take. And it will find these lows for you in an objective, rule-based manner. It'll even find that in a mathematical formula. So just go to indicatorwebinar.com, pick it up. By the way, for full disclosure, it is an indicator already in your chart. You just have to modify it. We do not use it in its default form. It doesn't function this way in its default form. So I modified it and customized it for myself, and now I'll share it with you. So if you like these videos, please subscribe to the channel. That way you'll get more notifications. You'll get, obviously, they're all free tutorials. Happy to share them with you. And subscribe to the channel. And again, just one last reminder, feel free to, in the chat or in the comments below, type in what your favorite volume indicator is. And let's compare. Let's see what you got and what you like. It'd be fun to see what everybody's using.